Capital Budgeting, a podcast project by Lourdes Directo and Sean Wilson. Companies make investments in long-lived assets. The decisions that are made on those investments are relevant because they have long-term effects on a firm's operations. Most firms carefully analyze the potential projects in which they may invest. The process of evaluating the investment opportunities is referred to as capital budgeting, and the final list of approved projects is referred to as the capital budget. Investment decisions involving the acquisition of long-lived assets are often referred to as capital expenditure decisions because they require that the capital, company funds, be expended to acquire additional resources. Investment decisions are also called capital budgeting decisions. For example, a shipping company wants to install a new conveyor line. A delivery company wants to buy new trucks. T-Mobile wants to open a new retail location. To calculate the present value, P, of an amount, F, received in years in the future, we divide F by 1 plus the required rate of return, I, raised to the nth power. The time value of money forms the basis of the net present value method for evaluating capital investments. The first step in using the net present value method is to identify the amount and time period of each cash flow associated with the potential investment. The second step is to equate or discount the cash flows to their present values using a required rate of return. The required rate of return is discussed later. For now, simply assume that the required rate of return, also called the hurdle rate, is the minimum return that top management wants to earn on investments. The third and final step is to evaluate the net present value. The sum of the present values of all cash flows, inflows and outflows, is the net present value of the investment. If the net present value is 0, the investment is generating a rate of return exactly equal to the required rate of return. Thus, the investment should be undertaken. If the net present value is positive, it should also be undertaken because it is generating a rate of return that is even greater than the required rate of return. Investment opportunities that have a negative net present value are not accepted because their rate of return is less than that of the required rate of return. The internal rate of return method is an alternative to net present value for evaluating investment possibilities. Like net present value, it takes into account the time value of money. The internal rate of return is the rate of return that equates the present value of future cash flows to the investment outlay. If the internal rate of return of a potential investment is equal to or greater than the required rate of return, the investment should be undertaken. For cases where cash flows are not equal each year, the approach previously presented cannot be used to calculate the internal rate of return because we cannot divide the initial investment by a single cash flow annuity to yield a present value factor. Instead, we must estimate the internal rate of return and use the estimate to calculate the net present value of the project. If the net present value is greater than 0, implying an internal rate of return greater than the estimate of the internal rate of return should be increased. If the net present value is less than 0, implying an internal rate of return less than the estimate should be decreased. Soft benefits are ones that are hard to quantify. When managers make investment decisions, it is important that they consider so-called soft benefits, in addition to a project's net present value or internal rate of return. Ignoring soft benefits may lead firms to pass up investments that are of strategic importance, especially investments in advanced manufacturing technology. For example, investment in robotics may be needed to reduce product defects. In the problems presented earlier, we simply stated a required rate of return that could be used to calculate an investment's net present value, or that could be compared with an investment's internal rate of return. In practice, the required rate of return must be estimated by management. Under certain conditions, the required rate of return should be equal to the cost of the capital for the firm. The cost of capital is the weighted average of the costs of debt and equity financing used to generate capital for investments. To be useful in investment analysis, both the net present value and the internal rate of return methods require a proper specification of cash flows. It is particularly important to remember that only cash inflows and outflows, not revenues and expenses, are discounted back to present value. In all of the previous topics, we ignored the effects of income taxes on cash flows. However, tax considerations play a major role in capital budgeting decisions, and we discuss them here. If an investment project generates taxable revenue, cash flows from the project will be reduced by the taxes that must be paid on the revenue. Similarly, if an investment project generates tax-deductible expenses, cash inflows from the project will be increased by the tax savings resulting from the decrease in income taxes payable. The term depreciation tax shield is used to refer to the tax savings resulting from depreciation. The net present value and the internal rate of return methods are widely used in industry to evaluate capital projects. However, many companies continue to use other, simpler approaches to evaluating capital projects. Two of these approaches, the payback period method and the accounting rate of return method, are discussed in this section. As you will see, both of these methods have significant limitations in comparison to the net present value and internal rate of return. The payback period is the length of time it takes to recover the initial cost of an investment. A significant limitation of the payback method is that it does not consider the time value of money. The accounting rate of return is equal to the average after-tax income from a project divided by the average investment in the project. We certainly hope that all the information in this podcast presentation has been helpful and clear. Thank you for your time and your interest in capital budgeting.